Hey everyone, welcome to this edition of Unshakable Living, where we take those shakeable aspects in life and get it to that unshakable state. Today we're going to continue with our segment on protection, which is Chapter 4 in the class. For those that have not been on these before, one, go back, check out some of the other sessions. We just covered term life insurance, how to take a look at that, how to figure out what's right for you. Today we're going to hit universal life insurance, variable universal life insurance, and index universal life insurance. And then we're going to have one final segment on the protection side, because this is a big section to really get your head wrapped around, and that one's going to be on the whole life or what I call permanent life insurance. But for today's purposes, Chapter 4, protection, universal life, variable universal, and index universal. So let's dive right in, and we're going to have some detailed information on this section. First part I'm going to show you today, numeric summaries. So this is a spot you'll want to ask whoever you're talking with if they're saying you're getting a flexible premium life insurance product, a universal life, a variable universal life, or an index universal life product. The numeric summary breaks down some of the sometimes overseen areas, I'll say, where they don't tell you too much about it. They just kind of brush over quickly. So this is an important page. Why is it important? Well, flexible premium or universal life products, they actually have different areas that are not guaranteed. Even though a lot of insurance people will sell them as, hey, you're going to have this death benefit forever as long as you pay this premium, you really want to make sure it is a true policy that's guaranteed and not just something the person is telling you. Numeric summary will help with that. If you take a look here, this is actually on a 40-year-old male, good health, $1 million of insurance, $12,744 a year is the premium on this. So you're paying a decent amount every year for this. If you take a look on numeric summary, there's guaranteed, non-guaranteed midpoint, and non-guaranteed current. What will usually be illustrated and shown to you is always this non-guaranteed current. That one overall looks pretty good. If I go down to the bottom here, by age 70, again, this client was 40 when he started it, they would have put in about $382,000, $382,330.80 to be exact. The cash surrender value would be, hey, if I want to get rid of the policy or if I want to take some money out, do I have something available? Yes, you do. $398,268. And death benefit still at $1 million. And if I go down here, what is the last year of the death benefit that I'll have if I have the non-guaranteed current rates? Age 120. Sounds pretty good to me. I like that. However, if I go on the guaranteed, let's take a look at this. By age 70, I've put in $382. I got only $155. I still have my $1 million death benefit. But if I go down here, age 77, what do you mean that's the last year I have my death benefit? What it means is at age 78, you don't have anything anymore. You paid $382,000 plus another 7 years at $12,000, so you're talking over $450,000 and you have nothing to show for it. That's one of those things I'm punching you in the face on. We talk about it a lot on these. I'm going to disarm you with the honesty and hit you in the face with some reality. A lot of times people miss that side of it. I've been on the unfortunate end, being an advisor, where I've had to come in and talk to somebody in their early 80s that was sold a product from a previous insurance agent, not myself, and tell them, you either have to pay a lot more premium or this policy is gone. And those are tough ones because I've done this over a handful of times, probably 6-7 times, and I've had to have these conversations with people on policies I didn't put in place. So that's where I'm very adamant of, I want you to know these facts so you can make a good decision if a universal, variable universal, or indexed universal life product is right for you in your life insurance. On those ones, what happens is when it gets to that point, they were usually sold a bill of goods from the insurance person saying, nope, you pay this premium, you'll have it forever. That is the thing I've heard from every single one of those people. I was told as long as I pay this, I have this death benefit. They never used the cash, they didn't use any of that, and I had to be the one telling them, no, what you have here is actually going to lapse, or it already had lapsed for a few people. So that's a very tough one, and usually at that point, mid-80s, maybe they're in a fixed income by that point, So it's been a very hard one to explain to people. This is what you actually have. So don't get hit in the face with that reality when you don't want it. Get it in the face right away so you can make the right decisions. Going back to our screens here, usually I tell people never bet on the guaranteed. It's going to do better than that. The only way guaranteed works is literally the next day the company says, hey, we're going to that maximum. So that's the nice thing. It's basically 99.9% chance you're not going to see that happen. But same with the non-guaranteed current, the one they are showing you. I say that too. Don't expect that to happen. Usually the midpoint is a good one to give yourself that buffer. Here you can see age 86 is when this one would actually be the last year you have a death benefit. So if you're comfortable with that, okay, then you can add that type of policy. Going on to what I call, it's not really fine print, but it's often gone over quickly or just paged through. A lot of times on illustrations and the actual policy, you have 20, 30, 40 pages of information. Most people just look at the numbers, and the insurance broker a lot of times will just point out those current value numbers. Here are some things you need to know on universal, variable universal, and index universal life. This is an actual one from a company. I blacked their name out because I don't want their company name out there. It's not saying it's a bad policy, just saying this is what's actually in the paperwork. Look for the non-guarantees. Right here it says other aspects of the policy are not guaranteed because no one can predict them with reasonable certainty. It's a great fact to state. That is true. We may change non-guaranteed elements at any time. The policy also allows blank company to change policy charges and cost factors, but the charges are guaranteed not to exceed the maximums listed in the policy. That, if we go back to the guaranteed, that's what they're talking about. Those are the maximums. These are all the different areas that could change. So variations in actual levels of credited interest rates and policy changes could affect the death benefit. That's a big one. The account value is able to surrender, so they're talking about the cash you'd get. Cash flow available to taken out, so if you wanted to borrow it out. Total out-of-pocket payments over the lifetime of the policy, talking about the premium you have to pay. So again, take a close look at those non-guaranteed rules. If we get into index universal life, this is actually the #1 sold policy right now. It's index universal life. Few reasons on it. One, a lot of people are selling it because it has an investment aspect to it. You don't need to be licensed for that to sell this product. I'd prefer you'd have to also be an investment advisor to be able to do that, but it's not required. So index universal life product, what it allows is you can go into an index, whether it's the S&P 500 or Russell 1000. There's all sorts of indexes they'll allow you to put a portion of the policy into. And the nice thing is, here's the selling point, you can get the upside on this, but we're going to have a cap rate on it. Maybe it's 10%. So if the S&P 500 goes up 20%, you'll get 10% of that growth. However, if it goes down 20%, yours is capped at 0 or maybe even 1%. So you can't lose money on that investment side is the pitch that's being put out there. In reality, what can happen, because all those variable expenses can change, including one very important one that's not locked in, is your cost of insurance. The cost of insurance, the way I explain this and the way I think of it is, if I'm 25 and in good health, I go out and get an insurance policy for $1 million. Probably going to be pretty inexpensive. If I'm 80 and want to get an insurance policy, the same amount of death benefit, how much more do you think that'll be? It's a dramatic amount difference. A huge difference. Usually after age 50, you start to see some pretty big increases. After age 70, some major increases on the cost of insurance. So even if my investment can't go down, but my cost of insurance is going up dramatically, that's where these things can falter, because if I have to pay $12,000 a year, but my cost of insurance is now $20,000, and my investment performance gained me 2, total, I paid 12, I got 2, that's 14, but the cost was 20. I'm negative 6,000. That happens over and over for a few years, then you're in a tough spot. So on those index universal life, other area why they're sold so much, if you take a look at the screen, didn't flip you over. If you're taking a look at the screen here, Same amount put in after or by age 70, $382,000, but $640,000 in cash value. That's attractive. Take a look though at the guaranteed. Remember how Universal Life was 77? This one's actually even younger at age 76. So even though this number looks really good compared to the UL, which was 398, that's why a lot of people are buying this, because they see this, they don't see the other side of it. Midpoint was age 89, so a little bit higher than what the UL one offered. But then also, they have even more items listed out here. Change can be to index cap rates, index spreads, participation rates, no less than the guaranteed, which your minimum index cap rate of 3%. Basically what that means is, how I mentioned the 10% cap rate, they could lower that down to 3%. They have the ability to do that. So again, the reason I'm pointing all these out is I want to hit you in the face with the downside of some of these, so that way you don't get caught off guard by just seeing the sunshine and rainbows of those nice big numbers that are put in front of you. Know what's in the fine print, or even though it's bold print usually, make sure you read through it and don't flip through those pages. Last one is variable universal life. I'm not going to show anything on that, but basically the variable universal life, same concept as like an indexed. However, it is actually in the market. It does go up and down based on the market. So there's no cap on the downside and no cap on the upside. You do have to be investment licensed to sell that one. Again, cost of insurance can vary across the whole thing. I've seen those ones go south as well. So be very careful with them. It's not to say universal life, variable universal life, and index universal life is for nobody out there. There are some great situations and reasons people will take those, and they are the best policy for some situations. So if you have questions on that, don't hesitate to reach out. I can get you some information on it. A lot of times we'll see it in estate planning, guaranteed universal life for a death benefit that goes on to for the estate planning. But other areas, definitely reach out. More than happy to kind of talk you through. So with that, stay unshakable and continue building a meaningful life. See you next time.